Welcome back. Well, let's focus on Maharashtra Seamless. The numbers in the second quarter were in improved performance in comparison to the first quarter. On a year-on-year basis, it's still a little bit softish. Let's understand a couple of details then. We're joined by Mr. Kaushal, who is the Deputy General Manager of the company. Hi, Kaushal. Good morning. Wishing you, your team, your family a very, very happy Diwali.
Happy Diwali, Nigel. Thank you for inviting.
Lovely. Let's get straight to business then. The EBITDA per ton of the Seamless division has improved. If I look at it on a sequential basis as well, it's shown a good improvement. Now, the first quarter was marked because of inventory losses. Were there some inventory gains in the second quarter? Point number one. On a steady state basis, what should the Seamless as well as ERW EBITDA per ton look like?
On the Seamless front, there were two factors which impacted us disproportionately in the first quarter. We had communicated earlier that those factors will normalize in the second and third quarter of this financial year. We've seen normalization in the second quarter. There were inventory markdown reversals in the second quarter on the Seamless front, and as also was the dispatches of high value orders, which could not take place in the first quarter, which affected the EBITDA in the first quarter disproportionately. That disproportionate effect has reversed itself in the second quarter, and the reversal is partial in nature. We expect that reversal to continue into the third quarter as those orders are not yet fully executed as per the dispatch plan of the customer.
Okay. What will
on the
mean
ERW front, we believe
Kaushal,
that...
if you could give us, Kaushal, sorry to come in, but on an EBITDA per ton, what should it look like on a steady state basis? The Seamless business as an ERW. Yeah, go ahead.
Okay. On the steady state run rate would be around 15,000 rupees per ton, which we had guided earlier. I think it was met with a significant amount of shock when this guidance was given earlier, because earlier we were doing much higher levels of EBITDA, but that was more on account of macroeconomic factors rather than anything else. We think going forward on a medium-term basis and going into the next quarters, 15,000 rupees per ton is a reasonable figure.
On 15,000 rupees. Yeah. All right. And on ERW?
On ERW, generally the EBITDA ranges between 4,000 to 9,000 rupees per ton. The reason for this variation is the product mix, because pipes in the ERW segment are further subdivided into two categories, the oil segment and the water segment. When dispatches in the oil segment are higher, EBITDA is higher.
Right. On the EBITDA itself, I just wanted to know, in terms of your clients, ONGC and oil, their proportion in your overall order book has come down. I'm given to understand that they are better margin businesses for you. What's the plan out here? What's the prognosis? Are you expecting some orders from them?
Yes, we are. We are getting regular orders from them. It is more of a timing difference, the way the order book is reported, because certain orders are under negotiation, certain tenders are in the process of being completed, certain tenders are in the process of being issued. But we should also consider that in the second quarter, dispatches of Oil India and ONGC related products were higher than they were in the first quarter, because bear in mind that in the first quarter, we were not able to dispatch the higher value orders of one of our customers, which ended up causing the EBITDA levels that they did in the first quarter.
So what quantum of orders do you expect from ONGC and oil in the next couple of quarters?
We would not want to give out a breakup of the customer mix, but what we would want to say is that we maintain a 3 to 4 month order book in the past so many years, and we want to continue doing that going forward. The reason why we maintain a 3 to 4 month order book is because we earmark our order book with inventory, so that our margins on a medium term basis are locked in and we are not impacted by fluctuating steel prices on a medium term.
Got it. All right. The rig business now, it's a very small part of your business. The EBITDA contribution has moved up from 12 crores in the first quarter to around 20 crores in the second quarter. So what kind of a quarterly run rate we should look at in terms of an EBITDA? Point number one. And sub-point of the same point is the rigs business could get a good buyer because of the rigs rates being revised upwards. And I think in the past, the street as well has flirted with the idea that you all could potentially do that. Any plans?
EBITDA on the rig business will more or less remain the same going forward because day rate has not changed. It's mainly a function of the costs that are booked into the P&L in any relevant quarter. So we would estimate around 45 to 55 crores would be the annual EBITDA from the rig segment. In the past, management has taken a view that we want to exit from this business because this is not core to Maharashtra Seamless. We do want to do that, but the proposal has not yet been put up with the board because the contract for the rig is till May 2025. Once we near the date of contract completion, we'll put it up and as per the approvals, necessary communication will be issued.
So just a follow up to that, because the contracts are all the way up to May 2025, once they are renegotiated, how much higher can they be repriced?
Currently, the last rig which was deployed with ONGC was at $88,000 per day. However, rig rates have since fallen. So we would estimate that for modeling purposes, one should take a rate between $65,000 to $75,000 per day.
Versus your locked-in rate would be what right now?
Our locked-in rate is $23,000, which is paid to us by the drilling contractor. The drilling contractor gets $38,600 from ONGC.
So 3x from here is what it can do in terms of the repricing. And with all costs remaining same, the EBITDA of this business can intuitively just triple if, everything else remains the same and the prices are negotiated upwards. Just trying to understand that.
I'll just correct you on that because the rates would rather double instead of triple because 38,000 is the rate received by the drilling contractor from ONGC, which would go up to 75,000 levels. So yes, EBITDA is likely to double on the rig front if we decide to continue with the rig. If we decide to exit the rig, then there will be larger impacts.
So drilling contractor receives 38,000 and you receive around 23,000.
From the drilling contractor, that is correct.
Got it. Got it. All right. What valuation should we give this in case you want to sell it? I mean, what is it? 10 times EBITDA, 8 times EBITDA?
I think you are a better judge for that. We won't be able to comment.
I'm the judge, but you're running the business.
Yeah, and you're the one who's going to sell it, right? So you're the one who will receive the money. There will be buyers. So irrespective of what multiple both of us put out here, it has to be a deal between you and the buyer, right? Typically, what is the multiple?
That is correct, but that working has not yet been done, so it will be too early to comment.
Okay, all right. But you're still sitting on a sizable amount of cash. If this goes, you'll be sitting on even more cash. Now, if I pull up the stock price, the stock has corrected sharply from the recent peak. Is there a possibility your shareholders would be interested to know what you're going to do with this cash? One time big dividend could come out. Maybe you do a buyback, which you'll have done in the past. Your view?
On the cash front, we have quadrupled the dividend which we paid out for FY24 from the levels that it was at FY22. Going forward, dividend is a way to distribute cash to shareholders. So is buyback, considering the new guidelines, because the impact of dividend or buyback is similar on shareholders from a taxation perspective. Therefore, both proposals can be considered, but nothing is on the cards right now. Whenever suitable approvals are received from the board, we'll let you know. But nothing is on the cards right now. The reason why we are keeping cash is because we have a capex of 852 crores, which we had announced some time ago, which we are working upon. Secondly, please bear in mind that the plant and machinery which we are operating is quite old. There will come a point in future where we'll have to replace the plant and machinery with absolutely new machinery because old machines are no longer available as they were available 20, 30 years ago.
Right.
When that happens, the replacement cost being prohibitive, and that is the reason we are able to maintain our market leadership position, we'll use the cash for replacement of plant and machinery.
Point taken. Thank you so much. Right.
Thank you.
Thank you so much for joining in, Kaushal, for giving us the details on your business and outlook on the EBITDA per ton across your verticals. Some more orders coming in the next couple of quarters. But most importantly, everyone will be looking at whether the rigs business gets sold or not. For now,